Look, the capital markets in general, the last 3 years for e-commerce businesses have been really tough. Very few very few equity investors are investing in D2C or in e-commerce anymore. I think the idea is you should be profitable from day one. And if you aren't, then there's something wrong and you shouldn't need additional capital. I think there's some exceptions to this. If you're growing really quickly and you need to buy inventory, but so many investors have been burned, both equity and debt, that I think it's been much more difficult to get capital the last 3 years than it was before. We have increasingly in the last few years moved to equity over debt. We did raise for Agora meaningful amounts of debt. We ended up paying off most of it a couple of years ago when interest rates rose. Cost of capital is higher on the equity side. You have to raise at a lower valuation, but you're giving up equity. It's lower risk than raising more debt and much higher rates. So that's generally the approach we've taken.
Thanks for listening to Margin Talks by Finaloop. Don't forget to like and subscribe on the channel you're listening to. If you have any questions or feedback, feel free to email me, fan@thehedgehogcompany.com. And if you'd like to see what Finaloop can do for your e-commerce business, please visit finaloop.com. We'll see you on the next one.